We are live already.
All right. Hi, everyone, and welcome to the Market Insights Virtual Summit that's happening on the...
You should know me already. If this is the
Before we get into
the link, I posted the
to do is just click on that link and that Alex has just sent in and relaunch the Mr. Boris Schlossberg. He is
work and we're ready to rock and roll. I got to tell you, I'm looking at everybody here, and my one big trading idea for not just the next year, but probably for the next century is eyeglasses. I'm looking at Jeremiah, I'm looking at Alex, I'm looking at me, and I'm looking basically at the advanced industrialized world. And the only thing that I think we can all agree on is that we're all wearing glasses. So there's your investment. You can all invest into Luxottica. I don't think they're ever going to go bankrupt with the way the world is going right now. Too much staring at screens, too much computer time for all of us, right?
Maybe.
The irony of the whole thing, by the way, is that I had the LASIK surgery. I had this beautiful 20/20 vision after having the worst vision of my whole life. And then, of course, I got old, and now I have to get reading glasses for the computer. So it never leaves you.
Yeah,
all right,
okay.
Boris, there's a great discussion. Already some good tips for the audience members, and we'll leave you to it to connect with the audience and kickstart your presentation. All right.
All right. The stage is yours, Boris. All right.
Thank you. Thank you so much, guys. Thank you. So great to be with you. I'm speechless, like everybody else is at this point. It's just impossible to even put into words the first week of 2021. I tweeted out the other day. I said 220 says I'm going to mess you up, and then 221 comes around and says hold my beer, which is just a Anglo-Saxon expression. It means you think you've seen bad stuff happening before. Take a look at what's happening now. So as we speak, just over the last 24 hours, we had massive geopolitical, of course, risks happen in the U.S. As you and I are speaking right now, we'll address this a little bit later. The Trump administration, the remnants of Trump administration, basically have opened up all relations with Taiwan, which, of course, is great on one side of it, but just an unbelievable tension point to the other side of it. I mean, if you're thinking about geopolitical tensions, this is literally, to me, in my opinion, will be the single greatest geopolitical tension point outside of the U.S. And Trump administration is basically just what's known as just burning the house before they leave. So there's certainly no shortage of themes. There's certainly no shortage of news hitting us. But before we kind of settle down and take a look at trading ideas, let's just recap and review. I want to take a few minutes to kind of recap and review with you guys what happened last year. Because let me see if I can share my screen with you guys. There we go. Should be able to see it. Because I think it's important to put everything into context, because so much of last year is really going to inform this year and allow us, I think, to make much more intelligent trading ideas and trading recommendations if we sort of understand the context of everything that's going on here. So before I start, as always, of course, past performance not indicative of future results. I'm gonna I have a couple of surprises for you today I think you'll enjoy. But remember this point, that past performance is not indicative of future results. Of course, nobody can really predict the future. All we can do is analyze and try to make the best possible probabilistic assessment of what's going on. So I want you to fully understand that trading Forex or CFDs or any other speculative product carries a high level of risk, may not be suitable for all investors, and a high degree of leverage can work against you as well as for you. So be sure to consult your investment professional before you proceed. And of course, we're not responsible for any losses incurred or any investments made by anybody here. All of this is done purely for educational purposes only. So with that said, of course, 2020 was the year of the coronavirus. And it's not like it's over. It's not even like it's remote. I mean, I know in Singapore it may feel like it's over. I know that in huge swaths of Asia, I know in Taiwan it was never even an issue. But right here, right now, in America, we had 4,000 people die yesterday. Yesterday, in one day, we are close to 300,000 new cases. we have very likely the new mutant strain of the coronavirus just spreading through certainly in New York and probably in other places. This strain is so contagious. I don't know how much you know about coronavirus at this point. I think almost everybody is a virologist. But there's something called an R naught. R naught is basically the multiplier factor by how fast the virus spreads. The R naught of this mutant strain is 80% greater than the R naught of the prior strain, which means that it's far, far more transmissive. And therefore, if you sort of model it out in its worst case scenario, essentially all of the US gets infected within the next 2.5 months if they don't stop it, if we don't control it. And of course, the control and the stoppage has been very spotty because one of the greatest and one of the worst parts about America is it's really not a country. As I think as everybody has seen, that the United States is less of a country in some ways than Europe. What I mean by that is that it's a federation of 50 separate states, and each one of those states has their own government and their own control over their people in a far greater autonomy than I think anybody in Asia can ever imagine. And that, in many ways, is great because it's one of the reasons why we have had a transition of power so far. Because if we had if we had a president that we just recently had who had full control of the United States of America, we would probably be looking at a dictatorship right now. But the bad part about it is because we have 50 different states, when it comes to public health, we have absolutely no way of creating a federal control program. Everybody is looking to President Biden to kind of institute a much more organized response to coronavirus. But as of now, the coronavirus situation is much worse than even in 2020. And I think that's one of the themes that the market is just sort of underestimating at this point, because everybody thinks that the vaccine and everything else is going to cure it. Right now, that's all basically a plan and not a reality. So this is old. This is old already. We're almost at 2 million deaths. I think this was done maybe a week ago, and you can just see the power of the new transmissive strain. I think we added probably another 5 to 6 million more cases over the last few days, and this just underlies how difficult the problem is in the Western economies. And U.S. is not the only issue. Of course, Europe is having a disaster right now too. Spain, all the countries that thought they had it under control are really not. UK is a complete basket case and is actually the center of this new transmissive strain that is, I think, going to really wreck their economy in a much worse way than people imagine. So, it's been an incredibly changed year. I don't think anybody would have imagined at the beginning of the year how radically all of our behavior changed. And more importantly, it's not just that how radically all of our behavior changed. It's my thesis is that the behavior will stay changed for much longer than people think. I think that a lot of things that people take for granted, which is travel, which is hospitality, which is socializing, both in terms of entertainment, going to restaurants, going to movies, will take not 1 year, but probably 2 to 3 years to come back to its prior 2019 levels, if ever. And I think a lot of things are actually going to change permanently as a result of COVID, including essentially a lot more e-commerce and much more virtual shopping. And certainly, one of the things that's really occurred, I don't know how much. I think you probably have all had the same experience in Asia, but in the U.S., nowhere has this been experienced as intense as in the U.S., where 40% of the workforce now works from home. Now, Kay and I have been working from home for quite a long time, but even I, I would be in CNBC studio at least once or twice a week. I'd be in CME all the time. I have not. The irony of the whole thing is, we moved to the suburbs. Was sort of like now we live half in New York City, half right outside of New York City in the suburbs, because as everybody else, we escaped the city in COVID. But where I live is literally 5 minutes away from the studio. I literally live. CNBC studio is is right across the George Washington Bridge, if you know New York City, in Englewood, New Jersey. And I live in a town next over in Alpine. And the irony of the whole thing is that even though I live literally right next to the studio, I haven't been to the studio in literally the whole year because all of our TV appearances and everything else is being done on air. And that's just a sliver of how behavior will change for quite a long time. Mask wearing, which was just unheard of in the West. It's certainly like second nature, I know, to a lot of places in the East, but mask wearing in the West was unheard of, and still a huge resistance here in all of the red states in America is commonplace, and I think will stay this way for far longer beyond when COVID disappears. If for no other reason, by the way, then one of the few positive side effects of all of this is we've had an incredibly weak flu season. We've had far less infections because people are obviously wearing masks. And I can tell you that when life gets back to normal, we go back to New York City, we go back to riding the New York City subway, there'll be a lot more people wearing masks all the time. I used to get sick all the time. Every winter I would get sick 3 or 4 times because of the flu. I don't think that's ever gonna be a problem as we go forward. So, the big themes of the year, of course, was this massive tech acceleration, the virtualization, what we call the virtualization of life, right? Everything in life became virtual. You're watching all your entertainment virtually. Even sports are now essentially played in empty stadiums, to virtual crowds. Movies are all done in-house. All the Wonder Woman and everything else that's been released. There's a great movie that just got released for the kids. What was it called? Oh my God, now I forgot. Is it Life? Oh, geez, the new Disney movie. I totally forgot. It's a great movie. I highly recommend it. That was supposed to be a big screen movie that just got released to home entertainment. Those trends are definitely going to stay the same. And as 220, came about, the big themes were the race for the vaccine, U.S. election, Brexit, Chinese, Australian trade tensions. Many of these themes, some of these themes are going to change, but many of these themes are going to continue just in a different format. So everything that was old will be new again, very much so. So the economic impact was horrid all across the world, especially in the first 2 quarters of the year, where there was just this massive contraction. And yet, stock market performance was much better than anybody could have imagined. We'll talk about why that happened a little bit later, but understand that a lot of what's really going on is the high value economy, the creative economy, the economy that makes the $200,000 jobs, not the $20,000 jobs, but $200,000 jobs, were completely unimpacted because all of those jobs can essentially be done virtually. And the true cost and the true kind of destruction to the economy was much more on the lower end. From a human point of view, that's a horrible impact, and we're going to have to deal with the societal issues of that for quite a long time. But from an economic point of view, it really isn't. 80% of all consumption in America is done by 20% of the population. And that 20% of the population is the high income, high education population, which essentially, not only has it not felt any impact from COVID, but in many ways is flush with money because nobody has spent any money on anything except takeout food and computer equipment. So in many ways, the profits of most of the corporations, which sell effectively to this 20% of the population, have really not been impacted as much as everybody thought, which is why you've had, in many ways, a non-depressionary depression. And it's a very weird situation. And by no means societally good, but economically really not horrible, meaning that it is the big term that everybody has used is something called the K-shaped recovery, which is that one part of the economy just does not just good, but even great, and the other part of the economy does horrible. Of course, it's an unsustainable situation, and we're going to have to really address this in a couple of, I think, very unusual ways. And we can talk macro about this for a while. I'm happy to kind of diverge into macro before we get to trades. But just know that the situation as it stands right now is great and terrible at the same time, which is why it makes it so difficult to kind of have a very clean argument one way or the other. So European employment, UK employment, all of it you see got bad, but none of it is in any kind of a depressionary level. I mean, they're all bad, but none of it are really horrible. And if you even this Friday's unemployment report in the US, where we were supposed to make 75,000 jobs, we lost 100,000 jobs. If you took away hospitality workers, which is workers in the hotels, and restaurant workers, which is workers in restaurants, we actually gained 400,000 jobs. The travel, hospitality, restaurant business is decimated. Tourism, which is 10% of the global GDP, is the one big sector of the economy that is definitely very badly hurt by all of this. But everybody else is fine. Everybody else is okay. You know, you can buy the car, you can buy a car online, you can buy all your goods online, you can do anything you want virtually, except basically do tourism. So in that sense, what you see is that the economy is able to function very smoothly. In some ways, you can make the argument far better, far better, far less friction than before, far more efficiency. And that's why you have this kind of a very weird dichotomy between the stock market and the economy. So you have the fastest bear market in the history, and then just a massive recovery, right? Like nobody could have predicted this recovery in the both velocity and the amplitude of the recovery. But it happened precisely because the truly productive part of the economy keeps chugging along. There really is, you know, as I said, with the exception of tourism, there is no major industry that's really been badly hurt by COVID. That hasn't been able to bounce back with a vengeance. So into this year, into 2021, a lot of these trends, as I said, are going to extend, but we are going to get some very different flavor as to what, you know, how and why policy, I think, is going to be disseminated. By the way, yes, that is Janet Yellen. I was very lucky. I ran into her at CNBC one day. Super nice lady, super nice lady. Very intelligent. She made me discuss Brexit with her for half an hour because she really wanted to understand what this was like 6 months ago when Brexit was really in the news. She wanted to understand it. But she's going to be the next Treasury Secretary, and I think, you know, she was one of the best fed chair people in the world because she really understood the need for stimulus, and I think she's really going to understand the need for continued stimulus going forward. So that's one of the things that I think we need to appreciate is that the idea of austerity, the idea of budget deficits mattering, the idea of any of those things will be swept out the door. We're going to see strong stimulus come through, especially now that President Biden has control of both the Senate and Congress. And it's going to be a very different kind of stimulus than we had under President Trump. So big themes 21. The truly biggest issue is vaccine rollout. And I wish I could tell you something intelligent. I wish I could give you some concrete forecast of where the vaccine is going. But the fact of the matter is, it's been a complete disaster under President Trump because there's been absolutely no coordination. It's an extraordinarily difficult logistical problem anyways, because it requires lots of refrigeration, right? They have to manufacture it. It's been hard to manufacture. But the problem is, even with whatever they have now, they haven't been able to vaccinate everybody at the speed that they need to do it. You know, the media has been just full of these reports of how when we had the polio vaccine, we were able to vaccinate literally the whole country in like 2 months, and we've only been able to vaccinate about 1% of the population, if that, I think, over the last month and a half. So the pace that we're at right now is completely unacceptable. And I think the single most important bullish factor that you will need to look at is whether President Biden, the first day in the office, creates a federal, essentially mandate, where like a wartime economy, where he overtakes companies. He has under wartime powers full control to tell companies to produce things, to manufacture things, and he can essentially have the Moderna vaccine manufactured in far greater quantities. Then furthermore, federally appropriate lots and lots of places across the country that become nothing but 24/7 inoculation centers, and achieves full inoculation or 70% inoculation within 3 months. That's massively bullish. But that's a big if. We need to see that. To me, that's one of the most critical things you want to look at into 2021 is can he seize the control of the bureaucracy and of the government to truly vaccinate the population, because otherwise we're running against a very, very vicious variant. As some of you may have read, California is over capacity. Los Angeles is completely overrun. The problem isn't the virus. The virus kills many people. That is horrible. Absolutely, it doesn't kill nearly as many people, for example, as the Spanish flu did. Right, so it's not nearly as lethal in that sense. But where it's a huge problem is that it puts so many people into a hospital. It literally puts the whole healthcare system into a halt. And if there is no healthcare, everybody else dies as a result. So that's the really big problem with COVID, is that it extracts all resources to just one particular healthcare need, and of course the world goes on. So that's going to be a really, really important thing to watch for over the next 60, 90 days. He knows, he's, I think, certainly prepared to really focus on this issue, and that's going to be a very, very key factor as to how fast and how well we recover off the COVID issue. And we'll talk about, of course, the post-COVID world investments that I think are interesting. We'll talk about the battle of giants with China and the U.S., which even as I speak right now today is going to become a very, very interesting chess match. And I mean interesting in not in like fascinating, but in dangerous, right? I mean it in truly the Chinese terms of like, may you live in interesting times, meaning that danger is a serious issue here. And of course, Britain versus Europe. We're going to talk a little bit about Brexit, which I think is going to be an interesting theme as well. So Biden presidency, what does it mean? It clearly means a couple of, it means, first of all, a completely different tone of governance than the one we've had. Most importantly, of course, it means multilateral cooperation, right? It means that America comes back from being a banana republic, comes back from being essentially, a low rent version of North Korea, into what it used to be before, which is essentially the foreground of Western industrialized, civilized nations working in a cooperative manner to improve the world. So we're going to rejoin the Paris Climate Agreement. We're going to repair the global relations. We're certainly going to get very, very close with Europe. That's going to be a very interesting thing. I'm going to talk a little bit about that issue as well. And diplomacy is going to become a much more normal thing. But from an economic point of view, the really big thing will be stimulus. Will be stimulus in a completely different way than we had stimulus under President Trump. So under President Trump, the first 2 years of President Trump, the money went. We've been running deficits forever. So, and we don't really have time to get into a big religious argument about why deficits completely do not matter. For those of you who really want to learn about economics, I suggest that you Google modern monetary theory, which is the true avant-garde thinking in amongst great economists, and stop listening to everybody who's giving you 18th century economics about how the world works. But be that as it may, we've going to run huge budget deficits for quite a long time. We've run them under President Trump, and going to run them under President Biden. The critical difference is that under President Trump, the money went to the people who already had the money. It went to the rich and to the corporate. Under President Biden, the stimulus should be a lot more stimulatory. If I give $2,000 to a restaurant worker, they will inevitably spend it, almost all of it right away. If I give $2 million to Jeff Bezos, he's going to do nothing with it. Okay, he will just simply park it in his stock portfolio, or buy another rocket with it. But the impact of direct money payments to people who spend 90 to 95% of their disposable income is very, very stimulatory to the rest of the economy. Because if I'm going to be spending money, that means I'm going to be buying stuff. That means the owner of the restaurant business or the coffee shop is going to make more money. He's going to buy more stuff. He's going to buy furniture for his house. The furniture maker is going to do this. It's what's called the multiplier effect. It will be a far, far more powerful multiplier effect because of the nature of the stimulus that President Biden is going to do this. So there will be the other big stimulus is that before President Trump used stimulus to lower tax rates. Now President Biden is going to use stimulus to give money to everybody else, but also what's called infrastructure projects. U.S. If any of you have visited the U.S. over the last 3 or 4 years, you understand that it's basically a third world country with a few patches of first world infrastructure. The roads are horrible. The bridges are horrible. The internet is laughably weak relative to the rest of the world, including Singapore. All of this is crucial to rebuild U.S. competitiveness. And I think President Biden understands that. So there'll be $1 trillion of infrastructure spend, which is also very, very stimulative, because this is the government not taking money and buying back stock with it, or issuing debt, or playing financial games. This is the government actually spending physical cash on physical goods, which then creates revenue for corporates, which then creates profits for corporates, which then obviously creates huge amount of GDP activity. So huge differences in the tonality. There'll be the same deficits, they'll just be spent completely differently under Biden than they were under Trump. And understanding that, I think, is going to be critical to understanding where the balance and where the growth is going to come from, right? There will be other. We've talked about the coronavirus vaccine distribution issues. The tech revolution continues. I mean, there is really there's nothing to say. More life is going to become more virtual for many more activities than we believe. We're not going back to a whole bunch of activities that people think we're going back to. In my opinion, in 10 years, you will never see a supermarket checkout cashier or a retail store clerk or any of those people really working. Like, those jobs just will not exist, because there'll be no need for them. We're going to virtualize a whole bunch of stuff that's going to radically improve it's basically all of our productivity, because there'll be far less friction in the world, right? I guess my point is, you'll never have to stand online in any store ever again, very, very soon. And that's all part of the tech revolution. But on a geopolitical front, the big story will be China, US, Taiwan, and how does President Biden deal with this? Now, this is much more complicated than just, Trump had a war with China and Biden is going to have peace with China. No, there is, I think, very, very bilateral or bipartisan support for challenging China at this point. China is now viewed essentially as the number one, what's the word I'm looking for? The word in English was really frenemy, right? Frenemy. That is somebody who you sort of do business with, but you're also considered to be your greatest adversary. And of course, from the Chinese point of view, they have done themselves no favors through the human rights oppressions with the Uyghurs, through what's going on with Hong Kong, which is horrified the Western world, right? And the fears now, and this is the really, really big fear, is if they're going to usurp Taiwan. Now, I don't want to get into a big political discussion as to who's right or who's wrong. My point is that if there is military movement towards essentially effectively bringing Taiwan into the Chinese fold, it's going to be very difficult for President Biden to just stand by and let China, control this, because the fear is that in the whole Asia Pacific basin, all the other countries will be next. So Vietnam is already got a lot of problems with China. Certainly Japan is, and we have lots and lots of Korea. All the allies of the U.S. are going to become a lot more tense if China makes any kind of military moves, which they very well may with Taiwan. Which is why Taiwan, China, U.S. will be, I think, the greatest geopolitical focus for everybody to keep an eye on. We'll see how that plays out. But that, to me, is the one thing that could really create, after COVID, create the super bearish, super ugly, super tense environment that could really screw up stocks very badly. From a legislative point of view, yes, we're going to have divided Congress, but much less. We prepared this presentation a little bit before the Georgia election. The Georgia election has really changed the dynamic. We are now in a situation where we have the presidency, the Senate, and the House of Representatives in the hands of the Democratic Party. Very, very slight advantage. Certainly, you're not going to have, what I would call massive. So the one thing I think you will definitely not have is higher taxation, even though, President Biden has said that he wants to raise taxes on the people who make $450,000 or more. I think the taxation, or raise corporate taxes by like 3 percentage points from 25 to 28. Even if he did, those are going to be very minuscule negative impact aspects of it, because the type of taxation increases we're talking about is very small. So, and I think there'll be a huge amount of resistance all across the spectrum to additional taxes, especially in a post-COVID environment. So I think the critical thing is, can he convince the moderate Republicans for the infrastructure spend and for the larger COVID spend, which at this point is enjoying 80 to 90%, I think, of popularity, and that makes it much easier to not worry about a divided Congress and basically focus on the major fiscal policies that he's going to be enacting. So if that does happen, so if we sort of take the view that they're going to control the vaccine by control COVID through vaccination by May the latest, right? That's a huge if. But if that happens, and they pass a stimulus bill with infrastructure spending, they're even talking about the idea of $1 trillion forgiveness in student debt, which is another very, very stimulative impact. This is a point that just came up today, and it's worthwhile to just discuss this for a second, because I think so many people outside of the U.S. don't understand this issue at all. In the rest of the world, in the rest of the civilized world, most people who are educated never have to be in debt for their education. Education is effectively free. It's so small. My kids who are Canadian nationals went to school in Canada, and their education was virtually free for me relative to what it would have been in America. Not the case in America. Education in America can often put a person $200,000, $250,000 in debt, which is effectively not a lifetime debt, but at least the first 20 years of your life type of a debt, type of a situation. You become an indentured servant to your degree. the people who, of course, are educated generally tend to be the higher value, higher productive workers. So if you forgive $1 trillion worth of debt to them, these are people who are earning 50 to 100,000 to maybe even $150,000 in income because they're well educated, they have good degrees, but a huge part of their after-tax income is going to service their debt. Now, put $2,000 or $1,000 into those people's hands every single month, and these people are earning quite a lot of money. That becomes hugely spendable cash, hugely stimulative too. So that's also a very, very stimulative move on the Biden administration part. The big question is, will they be able to enact it? So if you have broad stimulus and control of the vaccine, you certainly have the corporate earnings growth, the stock market growth, the strong recovery, all of these things, combined with the fact, we haven't even talked about this, but because we all take it as a given, that we all have low interest rates because central banks are very actively suppressing interest rates. They don't, frankly, they don't even have to suppress interest rates. All they have to do is they have to say that they are in the market, and they just have to say they're a willing buyer of bonds, and there's very, very little run on the interest rates. Now we've had a run on the long-term rate through the 1% over the last week and a half, and people are starting to freak out, as they always did, that we're going to have big inflationary pressures. But within the scope of first of all, where the rates were, and the amount they need to go to, they really need to go to about 2.5% before we even begin to feel any kind of inflationary pressure. The Fed has so much room and so much control and so much power to cap that move if they want to, that I think all of those fears are false fears. So from a Biden administration point of view, the numbers are kind of obvious: green energy, cybersecurity, vaccine, trade. But we're gonna discuss very, very. These are the consensus views. I'm gonna discuss some very out of consensus trades that we think might work in 2021 at the end of this presentation. But in the meantime, so we have, we talked a little bit about the Battle of the Giants. We talked about the fact that China is doing much better on the face of it, trade surplus, more easy. The really big question to me is, will Biden administration be able to temper President Xi's worst authoritarian instincts, right? We haven't even talked about Jack Ma. We haven't even talked about the idea that China's #1 entrepreneur, the man who's probably responsible for the greatest amount of wealth creation in Chinese history, is effectively now been erased from the world until we know where he's at. It's easy to say that China will become the strongest economy in the world. It's easy to say that, looking at the amount of people they have and the productivity of the populace and the educational populace and all those things, that they're going to be the leader of the world, and the U.S. will eventually fall. And that certainly is an easy conventional view to make. I'll just leave you with two big thoughts. Having been raised in a totalitarian regime like Russia, I can tell you that first and foremost, if you don't have freedom of expression, freedom of creativity, freedom of markets like you do in Western industrialized rule of law nations like we live in, you will eventually break the economy, because the economy cannot function under political rather than economic decisions, right? If all decisions are made for political considerations rather than economic ones, it's very, very quickly going to break. But a much bigger reason for why you need to think about the fact that China is really not going to be the leader of the world is that demographically, it's dying. Demographically, the country is getting older and older and older and not replacing its young population. And demography is always destiny for all nations, right? So it's going to be very, very U.S., especially under President Biden, who's going to create a much more open border environment. And if they were smart, would create more of a Canadian model where we would welcome every intelligent immigrant to our shores, will again replenish. The history of the US is always 1% of the immigrants, 1% of the population, which is immigrants, is responsible for 99% of all economic activity. I'm exaggerating in a huge way, but if you look at innovation, that's literally the story of America. America has always been living off the brains of the 1% of immigrants that come to its shores. And is when if President Biden reestablishes that model, I think it's going to be far less. It seems like America is losing now, but I wouldn't be making that long-term bet as we go forward. Now, the other big story is Britain versus Europe, who wins post-Brexit. And this, I think, is kind of interesting for all of you who are FX traders. So the big story, in Brexit was, as usual, the stupid story, the story that really didn't matter, the story that literally is an afterthought for anybody who's a serious macroeconomic player, which is British fish, right? British fish makes up 1/10 of 1% of GDP. It's literally like the most primitive economic good you can possibly get, right? The irony of the whole thing is for all of the crying about British fishing, the Brits themselves import, I think, 80% of their fish from Europe, just because the fleets in Europe are much more productive and much better than they are at fishing, period. I mean, but it's idiotic. It's like us talking about corn in the age of artificial intelligence. It is the most primitive, easy to get good in the world. The real story in Brexit is City of London. The real economic engine, the true power of UK stays. This isn't actually, ironically enough, this is the picture of Canary Wharf. If you know anything about London, the city is in the City of London, is in London Central. But this is new, sort of the new City of London. The new financial center in London is Canary Wharf. And I actually used to long time ago when we were at GFT, we used to work in a Citibank building. But the point being is that this has been the driver of growth in the UK, because UK stands at the crossroads between Asia and America, because UK is an Anglo-Saxon economy with the rule of law that is also very, very open and has very, very deep and liquid markets in a variety of instruments. It is, in fact, the single biggest place for derivatives in the European theater. It has a huge amount of expertise in all sorts of financial instruments, right? What happens after Brexit? This is going to be the really, really big thing. They left this issue completely unresolved. Will UK companies, will UK banks have complete and total access to the European financial markets? Will there be complete and total, what is it? I forgot what the word is. Equivalency, right? That is unresolved. And let me tell you that if that in any way, if there is friction between the Brits and the Europeans in other areas, the easiest and the swiftest way for the European Union to punish UK will be to make this part of their economy difficult to transpire, because all the money, I know everybody says it doesn't matter, London has 200 FX dealers, it'll always be the FX dealing capital of the world. No, it's just as easy to deal FX from Frankfurt and even Netherlands as it is from London. There's nothing special about this here. There's nothing special about the UK culture. All of these, I know everybody arrogantly thinks that there's something unique about it. It's not. If they take away their right to deal, the UK economy collapses, in my opinion. And that is the really, really big risk that you want to be analyzing as you go forward. In addition to which, the other big macro risk for the UK economy is, of course, inflation, because inflation is, if you're in a situation where you're importing lots and lots of your goods, which you will be doing from the European theater, and you've now created a trade deal where it's going to be a lot more expensive for you to get everything that you need, you are inevitably creating possibly a inflationary impulse inside of your economy. inflation, in my opinion, is never a demand phenomenon, with the exception of like, crazy situations like you had post-war Germany, which wasn't even a demand phenomena. It was a imposition phenomena. In the reason why Weimar had hyperinflation was because they were forced to pay off debts to the rest of Europe, and that, of course, created an untenable situation. So there was no demand. The demand came from external from the economy, not internal from the economy. So inflation to me is never a demand-driven factor. It's always a supply-driven factor. And if your supply function becomes very, very constrained, if it's more expensive to do goods, to do business, that inevitably bubbles up. And that's where it's dangerous, because UK now becomes a tiny little country with its own currency and its own central bank policy that needs to keep rates low. But if inflation is really high, they won't be able to do that. And they're going to be running very big deficits. And here, nobody's really going to want to own UK debt. They are very, very vulnerable to a speculative attack from the rest of the world. If the world sees three things: oh, they're no longer center of the financial universe, they have high inflation, and they can't manage their economy. This turns the British pound into the Argentinian peso faster than you can blink your eye. Now, that's not what I'm not suggesting that's going to happen, but that is something. I'm just sort of exaggerating the possible scenarios of where things could go as we go. On top of that, I brought this up because I thought this was very, very interesting. Now, Joe Biden, this is a clip from BBC, and he said this in jest, but in humor, there's always a huge amount of truth. So this is Joe Biden. BBC came in to talk to him. He says, "Oh, I'm Irish. I can't talk to you." The full clip was, "Oh, I'm sorry, I can't talk to you. I'm Irish." Right? What does this tell you? It tells you the other thing you have to understand is just how powerful the Irish identity is in the United States of America. Right? The Irish Americans in America identify themselves very much as Irish, and there's still a huge amount of resentment against the British. And especially if you were raised Irish Catholic, you despise the British, right? So Joe Biden is a well-seasoned politician. He's certainly not going to, be super nasty to the UK. But my point is, he will do nothing to maintain the special relationship that the US had with the UK for all of its years. He will turn his attention to Angela Merkel, to Ursula von der Leyen, to all the European nations, and create much deeper bridges with them than he will with the UK, especially if they start giving him trouble. And that's something that you need to understand, because if you don't get support from America, Great Britain turns into Little England, in my opinion. And that's what makes the pound dollar so vulnerable. So with that said, it's time to get to our trades of the year. But before we get to the trades of the year, I wanted to review with you the recommendations we made last year, because I think it's both informative and important to analyze how those things did this year. Right? Let me see if there's any questions. So far, I don't see any questions. If you have any questions, feel free to type them in the chat room. I'll take a look at them. But let's take a look at the trades of the year last year. Right? So the first trade that I recommended was actually the worst idea that we had. And it was based upon the idea that NASDAQ was grossly overbought, right? And my idea was to essentially get short NASDAQ, long Dow. The idea was that there was going to be a correction in the indices. Markets were overbought, and if they were going to be overbought, then NASDAQ was, because it was a much higher volatility index, was going to get punished. And I was completely wrong in my assessment. I underestimated, first of all, a couple of things. We underestimated nobody anticipated coronavirus, and of course the Dow, which is older economy, which is physical economy, suffered much greater initial impact from the coronavirus than the NASDAQ, which is all virtual economy, which had virtually no impact. So from that perspective, I think I underestimated. Secondly, I really underestimated the radical transition that's happening in our economy of everything becoming technology essentially eating everything in its sight, right? The technological progress, virtualization of all business transactions into software has certainly taken full hold in the economy. In our defense, we had a couple of hedges on this particular trade. One of them was just simply buy the QQQ calls on as protection. And had you done that, that trade would have certainly it wouldn't have made you money, but would have eliminated a huge part of the loss of the trade. The other idea was to buy volatility, which again, the only reason volatility was very, very low, and I had no idea that we're going to have coronavirus. But buying volatility, I don't think it would have made the trade positive, but it would have almost assuredly offset any of the losses that that this trade had. Let me see if I can. Let me see if I can get. Let me see if you guys see this. Oh no, I can't share this. I was going to share my screen. Okay, you're gonna have to take my word for it. I was going to try and share my chart screen, but I guess it's over here. I would have to share it over here. Okay, I'm sorry, guys. Let me see if I can do this. We have a little bit of time here. No. Okay, never mind. We'll stay with the PowerPoints. So the second idea that I had was gold. Gold worked really, really, really well. Gold did about a good between from the time that we recommended it to the time that that it went up, did about 20% higher at the beginning of last year. Gold was a great trade, but we had a couple of much better trades in gold. The recommendation last year was to go long Newmont Mining. Now, Newmont Mining is the only gold miner that was part of the S&P 500, had a 2.6% yield, but at the time of recommendation, the stock was trading at around 40. Peak value in 2021 was 70, so it was almost like an 80% gain without any dividend yield appreciation. It was a great trade, and it was really the smart way. That was my one smart trade on gold, far better than gold itself, right? The other trade that was also a really great trade, although it had its ups and downs throughout the year, was to go long the gold miners, the GDX, and short the GLD. The idea here being is that the rise in gold was going to have a much greater delta, much greater profitability to the gold miners than to the gold itself. So if gold rose by 20%, the miners were going to rise by 100%. And that effectively really was the right thesis. Everything collapsed during the coronavirus, panic in March. But if you look at the chart from March, and actually, you know what? Let me see if I could actually do this. We got a couple of minutes. I really just want to show this to you. Let me see if I can do this. Give me a sec. I thought I set this up earlier, but I didn't. Okay, let's kill this. Kill this. And if we do GDX against the GLD on a spread basis, right? And I'm going to do this on, yeah. So this is just, this is it's a 1 minute chart. I want to go one daily chart, the daily chart, and we'll do a line chart just so you guys can see this. Okay, look at this massive move. So I'll get rid of the EMA here. Look at this massive move from the lows of March. It was effectively, I think on a percentage basis, it was like a 50% move. It's a huge move. It was from -30 to +20 on the move. So it's a 50% gain at the end. And now it's sort of, the flatlining because gold itself is no longer that interesting a story. But that move was a great trade on GDX versus this. And then the last trade of last year was a currency trade, which was euro pound to the upside. At that time, euro pound was 84. It went up to about 94. It was a 1,000 pip trade. This was obviously the trade on the fact that Brexit developments were going to be negative UK and more positive euro, and that definitely turned itself out. So you certainly had a pretty decent result from the ideas of last year, and now we got time now. Yes, we do. I'm actually going to go through this relatively fast because I want to talk to you a little bit about some other stuff that we have going on. But now come the ideas of 221, and we'll take a look at Forex, stocks, indices, crypto, and commodities. I want to kind of discuss with you where the possibilities are. So on Forex, the single biggest story here is the weakness of the dollar. We have negative rates early on. We're going to have more fiscal stimulus, reflation steepener. We're going to have less protectionism. These are all the big stories on selling the dollar. But the fact that U.S. policy is going to remain very, very accommodative, both on a fiscal and monetary front, suggests that U.S. yields are going to stay very, very flat for quite a long time, and they're going to be a drag on a dollar for quite a long time. And the key question here is, what would you like to sell the dollar against? That's really, the really big question for going forward. If you are trading in Asia, Kathy's recommendation were that won, ringgit, rupiah. Those are, of course, not very liquid currencies. If you're trading on a much more liquid world currencies, then you want to be trading sterling and the New Zealand dollar as the trade. But her recommendation is actually to sell the Swiss franc. That's the best idea she had, which is the idea that basically the dollar is going to recover, right, on a resurgence of growth and stimulus, and the franc itself has been so strong for so long that the Swiss National Bank has had to intervene continuously and has threatened to intervene continuously because it's just becoming an incredibly deflationary environment for them. So the idea of the dollar recovering against the Swiss franc gives a tailwind in terms of if you're going to pick it against the major FX currency, and it also, because of such negative interest rates in Switzerland, provides you with a positive carry trade. Especially, this is the key thing, if U.S. rates continue to percolate higher, even if they don't go, which I don't think they're going to go to a full inflationary level, even if they go to 1.5, the relative movement in U.S. rates really creates the Swiss franc long side as an interesting trade. Now, on the stock side, it's easy to say buy infrastructure, buy green companies, buy ESG. But to me, the very, very interesting out of consensus trade is to actually buy oil, which everybody hates. And not just to buy oil, but to buy oil companies. So oil of course, has had a big recovery from the collapse in May, which was really engineered, to essentially now trading at it's very, very flat. Let's just say we have an average price between $40 to $60, or let's just even $45 for the rest of the year. The Russians have curtailed production. The Saudis have curtailed production. The world is coming back from its complete absence of economic activity. The crude contract is going to stay at these levels or get better, and that's all you really need, because you don't need it to really skyrocket. You just need it to stabilize, because if oil stabilizes, then all of the oil majors, which trade in a ETF called XLE, Energy Select Majors, just can catch their breath. They have been battered and destroyed on COVID, low oil prices, collapse of capital requirements, all those things that of course we all very well know. At the same time, look at the dividend yield on this thing. It's a 5.5% dividend yield. One of my strategies for investment purposes is I want to get paid while I try to let my thesis work itself out. You saw that the way that played out with Newmont Mining, where I was getting paid 2.5% just to hold the stock, and the stock itself went up 60, 70% from there. Similar kind of a story here. The XLE itself has got this is the ETF, so it's well diversified. You're not even exposing yourself to one single oil name. Therefore, the risk of bankruptcy is of course much smaller. But as an ETF, it gives you a very high yield. Will that yield stay at this level? Probably not. But if oil stays stabilized at this level, if oil can stabilize at this level, they may be able to preserve the cash flow to keep the dividends going, because oil companies know that if they can keep their dividend going, investors are going to really revalue them much higher. Technically, you can also see that the ETF has made a very clean double bottom here. It's basically basing. So if you have oil stationary getting a little better, the trade back into the oil companies, despite all the talk about green energy and everything else, just simply the world coming back to functioning, the world coming back to needing energy, I think will be a strong trade. They don't have to grow forever for you to make money in this thing, because if the XLE goes to 60, you're talking about a 50% move from here. One of the other ways that this is going to happen is that always in a shrinking marketplace, you get mergers and acquisitions. And as companies acquire other companies, you're going to get rationalization of costs. You're going to get much more efficiency and much more greater extraction. So for every dollar in crude that they get, they're going to be able to get even more profits and maintain those dividends. The bottom line is oil is not going anywhere for the next decade or two, and we're just trying to trade for the next year or two. So to me, the possible bounce back in oil is a very, very strong story. And of course, you have the safety of numbers in the XLE. My third idea could be my worst idea. And I'll say that to everybody right up front, because I am going back to the well. I'm going back to the idea of betting against NASDAQ. And that could be, again, a fool's errand. Although, even a broken clock sometimes is right twice, right? Is right twice a day. Here, the thesis is sort of interesting from a technical as well as as a fundamental point of view. Technically, what you see here, this is the Russell 2000, which is the mid cap, basically Main Street America against high technology America, right? And what you see is that as strong as high technology has been, it's running out of gas. It is so grossly overvalued. How overvalued is this thing? This is from the other high technology bubble through which I lived also. I traded AOL. I traded Cisco. I traded Dell. I traded every one of these stocks. I traded Microsoft, which, by the way, for the next 20 years made zero, bagel, as we say in New York, made zero money for the next 20 years until they were able to kind of, they were actually, as a matter of fact, the only company on this list that's come back from the dead that was so highly overvalued. So to me, Amazon and Zoom and Facebook and what are the other ones that I'm thinking about? And Shopify and every one of the high-flying companies that is trading at 70, 80, 90 earnings. They are the greatest business in the world. I love them all. They're all going to die. Cisco is still in business, right? Cisco is still in business. Dell is still in business, right? Microsoft was all the way through in business. The fact they're in business does not mean they're going to be great investments. That, to me, is probably the single greatest reason to short the NASDAQ. It's just so grossly overvalued, so grossly overbought. It's really a relative value trade. We're basically trying to be market neutral. We're betting that if the market rallies, the smaller stocks, which are much cheaper, are going to outperform. And if the market declines, the decline in the QQQs is going to be much sharper decline in the Russell 2000. So short the IVW, which is the Russell 2000 ETF, against the QQQ. No hedges here. No hedges here. This is the straight up play because I'm basically making a trade on valuation at this point. And there's, I'm not hedging my position. Now, Bitcoin really, this is not an investment. It's not even a trade. It's just a conversation. I mean, your guess is as good as mine as to what we hit first, 50,000 or 30,000. The only thing I do know, the only thing I do feel very, very confident is clearly Bitcoin is the new gold. Absolutely, positively. What I mean by that is that when you look, Bitcoin is effectively a societally accepted store of value. That's what gold is. Both gold and Bitcoin are utterly and completely useless, complete waste of product in and of itself. I know you may think gold is valuable. Gold has zero value, okay? If you're going to start telling me that gold has value as a jewelry factor, 1% of global demand is satisfied by jewelry. In other words, every year, gold mining companies produce 100 tons of gold for every 1 ton of gold used in jewelry. In no other imagine if there was 100 tons of wheat produced for one ton of wheat actually used. Imagine if there was 100 tons of aluminum. If there was 100 tons of copper for every 1 ton of copper being used. There is no commodity where the supply is so much larger than demand. So gold is useless. Gold is just simply a brick of metal that people decided has value as a store of value. Same with Bitcoin. Bitcoin is just a bunch of code that people decided that has value. The critical difference, and the reason why Bitcoin is so much better than gold, is that you can carry $1 billion in this tiny little portable flash drive. You can't carry anything. You can't carry even $1 million worth of gold when you're leaving the country. But I can take $1 billion, I can take $10 billion, I can take $1 trillion worth of Bitcoin in this tiny little thing. And it's the portability, it's the pure portability, it's the virtualization. This is the sort of the ultimate example of how world is becoming virtualized. We're going from real things to virtual things. And nothing is more virtual than Bitcoin, and yet nothing is more real than Bitcoin. So to me, the big thing is, where does Bitcoin go on a longer term basis? If you look at any of the other bubbles, and including the original, the baby bubble, the original gangster bubble of them all, which was the tulip mania bubble of the 1600s, ultimately, at this peak where you see the peak over here, one tulip was worth the value of one house in Netherlands, right? So if you use that approximation, if you say, okay, if this thing gets completely out of whack, what is its terminal value? Well, the average house in America is between $150,000 to $200,000, which I think is a reasonable long-term metric for Bitcoin. Now, is it going to have a 50% correction, from there? Of course it will. The bigger question is, Bitcoin is not a trade. The Bitcoin really becomes a kind of a longer-term investment. It becomes a store of value. It becomes a hedge, as one French money manager once said to me. Gold is not a trade; it is a hedge. Bitcoin is the hedge. So certainly, long-term, I think Bitcoin is a very, very valuable hedge. Does that mean you have ample opportunity to lose 50% of your money? Will it drop to 20,000 in 2 weeks? Absolutely possible. The volatility in this thing is enormous. It's hugely, it gets swung by some very, very large players. 95% of the stock is controlled by 2% of the players, so they can really move the thing around. There's clearly new participation, and people are all coming in. But the bottom line is, until and unless somebody invents a brand new idea of store of value, this is the store of value. Remember, store of value takes a long time to change. The people who are long gold right now are not going to go away, and the value of gold will still remain as a strong trade. But in a relative sense, Bitcoin, I think, is going to outperform it on the crypto side. But of course, you need to be very, very prepared for volatility. And then, of course, the final component here is gold itself.
Sorry, Maurice, you've got 10 minutes left. Time check for you.
Sorry?
Or 10 minutes left for your speaking slot.
You have what? I can't understand you. 10 more minutes.
10 more minutes.
Yeah,
10 more minutes.
I understand. Very good. Very good. We're wrapping up. So I'm going to wrap up by saying gold is always an interesting hedge, especially if you're a believer that interest rates are going to, that inflation expectations are going to rise, that we're going to, have a weak dollar, and then we'll have some recovery of physical demand. It's always, I don't think you're going to get hurt in gold, but certainly, on a relative valuation basis, Bitcoin has become the new gold. That's become the new baby. There may be, I think, a time in this year when Bitcoin drops by 50% in a week that people are going to run to gold. So if you're looking for a much lower volatility profile for a store of value, gold still remains a very, very interesting commodity as a trade as we go. So those are the 5 big trades that I bring you this year to sort of summarize them. Long dollar Swiss on the idea that if dollar is going to recover, it's going to be against the Swissy first and foremost. Long oil companies as a completely out of conventional trade, on there. Where am I? I got to go back now. I forgot before the crypto. What are we talking about? Oh, indices. Really tough trade, but I think one that's going to work, which is long Russell 2000, short the Nasdaq on just the popping of the valuation bubble in the Nasdaq, and then of course Bitcoin and gold as stores of value, but prepare for just massive volatility. And if you want to avoid the volatility, just simply stay in gold as a way to hedge everything else that you're doing. So, aside from all of this, what I really want to talk to you about right now is that we've been working super, super, super hard in BK this year on creating the best possible way to trade through this volatility. Through this volatility, it doesn't matter if all my ideas fail, I will feel 100% confident I will make money this year. And the reason why is because through all this volatility and through all of the market movements, we've been working away at the system that I sort of, been refining to the point now where every single day, this is, I'm not exaggerating, I'm showing this to you because this is all on the YouTube channel. You can watch me. There's nothing I'm telling you right now that cannot be verified by actually watching me trade. Every single day this year, almost every single day in December, almost every single day in November, we made money day trading the system that I developed called Fly Away. And I wanted to spend a couple of minutes just telling you about how interesting and how valuable the system is. So basically, it's a system that I've been trading NASDAQ, Dow, Euro, and Pound. But the thing about it is that it can trade anything you want. It can actually trade Bitcoin super well. I just simply can't trade Bitcoin because as an American, I don't have access to the CFD markets like you guys do. The thing produced more than 500 pips over the last couple of months, just 2.5 months of live trades, essentially like a 95% winning day structure. And we have not had a losing day in the last 10 days because we really refined this thing down to a T. It has, when you're investigating how good a system is, one thing that you want to examine is something called gain to pain ratio. It's like how much money does it make relative to how much money, what's the worst that it loses to the best that it makes. And the worst that it loses to the best that it makes has an incredibly strong 10-to-1 ratio. The worst we were down all throughout this time was 40 pips. The best we made was about 495 pips. That's where we ended up on the strategy. So what I want to talk to you about today is the fact that this is a system that we have created on a day trading basis that works just as well. In fact, I would argue even better on a swing trading basis and even on an investment basis. It's fully fractal. I trade it on a 1-minute chart, but you can trade it on a 1-month chart if you wanted to, because the structure behind the system, the idea of how it works, and the money management and all of the tactics that we use in it, which I'm going to teach you right now, teach you in a course that we're going to do in February, is going to literally set you up, in my opinion, for life as far as the ability to trade it. The skills of this system is that it trades momentum in trend. It's always on the right side of the trend, and it trades it super, super, super well. I'm going to just show you a couple of examples. I have 5 more minutes, right? I guess.
That's right.
Okay.
Yes, that's
So
right.
I'm just going to show you a couple of examples, and then I'm going to show you, and then Alex has the link to the course, and I'm going to tell you a little bit about the course. So this is just a 1 minute chart, 1 minute chart of the trading view version of this. We have this. What we've developed is the system in MT4, MT5, and Trading View, and you will be able to, when you sign up for the course, get not just the rules, not just all these strategies, not just every time frame that we talk about, not just the day trading time frame, but the swing trading time frame and the rules for the long-term time frames, but the flyaway EA, the MT4 and the MT5 tools that help you put this into play. But I just wanted to show you how on a on just the 1 minute charts, this is the end of the day on NASDAQ, how the system just caught every frigging move. Buy, 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 buy. Now, as I said to you, I am an inveterate day trader. We trade this literally 10 to 12 times a day, every single day in my chat room. People are very, we come in, we try to make 15 to 20 NASDAQ points every single day in a matter of an hour. You can do it this way. You can trade it in the Asia session and make 15, 20 points trading Asia, trading the Hang Seng, trading, even trading the NASDAQ in the overnight session, which is what I do all the time as well. You can do, it's very, very flexible. But the key thing is that for those of you who don't really have the inverted gambler aspect of it of day trading, and you want to really use this on a long-term trading basis, it's amazing. I'll show you how this trades. We can just take a look at the euro dollar on just like an hour on the hourly basis, right? And you will see that even on the hourly basis, it provides tremendous amount of interesting buying opportunities. Every one of these buys is a profitable trade. Now, when you see the sell signal here, I'm not gonna, I don't have the time. I would love to, I'm happy to tell you this, but I just don't have the time right now. The sell signal here is not a sell to make money, even though you could have made money on the sell side here. We use the sell signals in an uptrend essentially as buy opportunities. We use the buy signals in a downtrend essentially as selling opportunities if we get them. But the critical thing, and I'll just give you one simple little clue as to why the system works. We never, for example, if we were gonna sell, this is a buy in a downtrend. If we're gonna take this signal, we would take the signal only if the price closed below the buy candle. Only if it closed below the buy candle. So we never make bad trades. You see, we had a negative bias here. We never took the trade. On the other hand, here's a buy signal over here, and the low of the buy gets broken on this candle. We took this trade, and you can see how in the euro dollar it's just easy money. It flows. It's a pure momentum trade based on flow. Now, I spent months coding this stuff to make it super simple, to make it super easy. We have tools that execute this thing in 5 seconds based upon the rules and the codification of how it works. But this one brilliant insight, which is if I'm right, I have a thesis, and there's 3 scenarios in my thesis. I'm right, I'm going to make money. I'm wrong, I'm going to lose money. Or I'm wrong, and I'm never going to be in a trade. I have now put myself 2 out of 3 positions into a positive territory. In 2 out of 3 choices, I am winning, because in one case I'm not losing, in the other case I'm winning, and in the third case I'm losing. Furthermore, add to the fact that the accuracy of this thing is around 80%. The times I'm choosing my winners, I'm 80% positive. The time that it makes false losers, I'm only 20% into the trade. You can see how the spread becomes incredibly positive. So, with all that said, Alex, do you want to give them the link on the offer?
Yes.
Okay.
Be able to see the link right on the right-hand side of your screen.
Okay. So you are seeing the access to our I wonder if you can. I want to share this on my screen. Hang on a second. I'm sorry, guys. Let me just. I need to get the proper link for you guys on my screen. Just one sec. I'll pull it up. The point being that I wanted to tell you is that this course is gonna sell off in a matter of minutes. I'm just gonna let me put you on the chart. What I wanted to offer you guys is you've been so kind to hang out with me for the last hour and a half, and because we love we love Market Asia. For the first 50 people, that sign up for this course, it's going to be 125. We're going to give you instant savings right now. It's going to go instantaneously to probably triple its price after the offer is made. You're actually the first ones we're making this offer to. We haven't released this course. It's going to go live on February 7th. So if you sign up right now, you're going to make sure you're going to lock in the price. You're going to lock in the access to the EA, to the robot, and you're going to be able to lock in the access to the live trading. If you can't make the live trading, which I'm going to teach you on, that will be recorded and you'll be able to see it on demand. So nothing will be left to chance for you. You're going to have all the on-demand videos. You'll have all the rules. You'll have all the tools. You'll have all the ability to trade the system, which, as I said to you, I trade myself every single day. It's literally the best thing I've ever done. I intend to trade this probably for the rest of my life, and I'm hoping that those of you who are interested in trading are going to be able to use it and trade it just as well. Do we have to go? We're out of time.
So somebody asking, is there a promo code? The promo code is already factored in already. So the special price for this summit is at 125 USD, is US dollar. So translate to about Sing dollars, about 160 plus. So this is already a discounted price already. And yep, so this is for the first 50 people who sign up for this course with the on-demand video plus the expert advisor indicator. All right, so yep, so you should see the button at the right-hand side of your screen. Okay, the Get Access Now button.
As I said, you are the first ones to hear about this. It's going to go dark very soon. We have not released this system to anybody for a long time, and I've actually had a few people in my chat room already coming ask me, can I have it? I said no. So you have the first chance to lock in this price because it's going to go triple very, very soon. So I'm hoping, if you're interested at all in learning how to trade across multiple time frames, multiple instruments, multiple abilities, FX, crypto, and indices, I will be super happy to teach you the flyaway system. And I hope you guys are going to be able to sign up for it.
All right, so thank you, Boris, for your sharing. And
thank you very much.
Next room already. The next room is by Chris Weston from Pepperstone. He will share with you how to trade in volatile market, and you should see the link on the yellow box. And I am also posting the link on the chat box over here. Okay, you should see the link over here. All right, so I will see you guys in the next room, and see